Welcome into another Tax Talker, and today we're talking Trump accounts, one of the most talked about areas of the new tax law, dismissed by some, praised by others, a lot of confusion. Today I want to do three things. First, let's talk about what we know about these accounts. Second, we are going to explain why these really are not big tax savings vehicles. And third, we'll step back and talk about why these are still pretty interesting and probably aren't going anywhere. Let's get into it. At the basic level, Trump accounts are a new investment account for children, for minors under 18 years of age. Any child with a valid Social Security number can have an account open for him or her. And then most notably, children born between 2025 and 2028. That's January 1 through December 31st, 2028, will have their account seeded with funds, with $1,000 from the federal government. Children outside that window can still have an account open for them and contributions made. It just won't be from the federal government as of now. This account then gets invested, it grows over time, and that growth is tax deferred until the age of 18, when the child can take distributions from it, and these will work like an IRA. The distributions they take are subject to ordinary income tax. Outside of the federal government, individuals can contribute to these accounts. And in fact, you don't have to have any connection with the kid. It doesn't have to be your dependent or a familial connection. People can contribute up to $5,000 to an individual's account, and employers can contribute $2,500. And that's annually, and that's on top of if the government seeded funds. Again, at 18, that money can be taken out and used for any purpose. It can also be left in the account. There's no rules as of now about a type of required minimum distribution scheme like we have with IRAs. Currently, it would all be subject to ordinary income tax when it's taken out. Though it's notable, there's nothing stopping Congress from down the line designating certain uses of the money as tax-free. Now, the way the law was written, these accounts cannot be opened until a year after, so July 2026. So it's giving the government time to sort through how this is exactly going to work. Now, how are these accounts going to be opened on behalf of minors? How are they administered? How are they invested? These details are still coming. But based on other programs, we can make some reasonable assumptions here. First, these accounts almost certainly will not have to do with the income tax return. You're not making an election with your 25 return, and I would bet good money you won't be doing so with your 26. It's much more likely these accounts are going to be opened through an online system, like what the US Treasury already runs, like with Treasury Direct. And these accounts will be titled to a specific child and their Social Security number, so there'll definitely be some interplay with the Social Security Administration. And on the investment side, we know that options are going to be limited, but they are going to be equity-based. These will likely be broad, low-cost stock market index funds of some sort. And finally, contributions, whether from parents and grandparents or employers or even third parties, these will likely flow through some centralized system. Now let's talk through the tax angle. As of now, from what I know about the law, I would say Trump accounts are not going to be a tax planning or tax strategy optimizing tool. Individuals can make contributions with after-tax dollars, so that's actually worse off than an IRA where you get a deduction and then later on can take the money out. Individuals putting money into this account on the behalf of minors are not getting any sort of tax benefit. And as of now, again, there's no tax-free uses for this money down the line. There's no Roth-like treatment. Money will come out and be subject to ordinary income tax. Again, Congress could change that, but as of now, that's how it is. Really, the only meaningful tax angle is employer contributions, but I think even here we need to be careful about getting too excited. Employers will be able to put up to $2,500 in for a minor on behalf of an employee. This will be treated as a fringe benefit, meaning it's a deduction for the employer and it is not taxable income to the employee. So in that sense, it does function like other forms of pre-tax compensation, like your health insurance. But it's definitely important to keep perspective because these types of benefits exist all over the tax code and there's very strict rules around them. For one, employers offer fringe benefits uniformly. meaning if you offer this program, you got to offer it to all employees. There's definitely rules around owner employees benefiting from this. Expect for S Corp owners, for instance, if they're greater than 2% shareholder, the normal rules are going to apply, meaning that owner employees typically still pick that up as income. They don't get it as tax-free income in the way normal employees do. So I would definitely assume that business owners cannot fund these accounts with pre-tax dollars, though we'll wait for final guidance to see. Bottom line, if you're looking for a clever way to reduce your tax bill, this is not going to be it. These accounts are still going to matter. I see a lot of the tax world dismissing these as gimmicks, but I don't think that's the right approach here. It's important to understand what these funds are competing with. These are not an alternative to 529 plan. They're not trying to compete with different forms of tax planning and wealth building. They were definitely not created with financial savvy people in mind. It's really the opposite. It's made for families that likely wouldn't have any sort of investment vehicle anyway. It's really a default way to build some wealth. Even if no one adds another dollar to it, it doesn't require someone to open it for the kid. It's going to be automatic. Flexibility is also intentional here. The family doesn't have to predict the child's path, whether they're going to college yet or what they might need funds for when they turn 18. From a policy perspective, they're not trying to give another tax shelter to upper middle class people. This is supposed to be a simple wealth building tool available at the lowest rungs of the socioeconomic ladder. And this framing is already reinforced by the fact we're seeing philanthropic interest in these accounts. There have been pledges to supplement these accounts for low-income children. Now, it's definitely worth addressing the elephant in the room. These are called Trump accounts, and I don't know if putting the president's name on it was the greatest way to get universal buy-in. And of course, any government program is going to have its issue. But if you take a step back from the immediate political reality, this is not a new idea. Child investment accounts, sometimes called baby bonds, these have been part of the social policy conversation for decades. And in fact, this comes more out of a technocratic center-left perspective. But what's interesting here, especially for the longevity, is how this pulls together multiple perspectives. People with a free market or libertarian perspective like broad access to capital and market participation. Those focused on inequality and opportunity gaps are going to like the idea of seeding accounts for kids who probably would never have access to these financial assets otherwise. Policymakers, whether leaning right or left, now also have a massive new government program and a flexible framework for adjusting this thing over time. But the big takeaway here is Trump accounts definitely not going to change the way you do tax planning. They're also not the way you're going to do wealth management or financial advising. They're pretty boring from those perspectives. The flexibility makes this very compelling from a social policy perspective, and the way this appeals across different political priorities and ideological perspectives suggests this is here to stay, even if the particulars evolve over time. As always, the details will matter. These accounts start getting formed July 2026. And we'll get more guidance along the way, and we'll have it for you on this channel. Be sure to like, subscribe, drop me a comment with your questions for the new tax bill and 2025 tax preparation. Thanks for watching. We'll see you next time.